The Singapore FinTech Festival is back as an in-person event for the first time since 2019. And a select 5,000 participants got a chance to try out the digital Singapore dollar. Now, this is the first in 4 trials being rolled out by the city-state's central bank. It could help remove some last-mile inefficiencies in transactions. That's what we heard from the Chief FinTech Officer of Singapore Central Bank, Sopnendu Mohanty.
The idea is to really find a place for the retail CBDC, as we have always said that it is in Singapore we don't have a particular use case, but we believe with technology, with this technology of able to program money, can we build a use case and remove some of the last mile efficiency, especially in certain use case as you see being trialed on the voucher side, on the distribution side of benefit transfer to people who don't have account. So there are this endpoint last mile use cases, and we are trialing to see whether we can make it more efficient using a purpose-bound money, and that's the intent. But the broader sense across beyond Singapore, there's a whole exercise how to use retail CBDC as to solve some of the last mile payment challenges in many markets. Singapore particularly may not have that need, but many other markets could be looking at a larger widespread deployment of retail CBDC.
One of the key trends gaining much traction in fintech space is buy now, pay later, or BNPL schemes. This option is especially popular with the younger generation, drawing them with interest-free payment terms without the need to own a credit card. Now, CNA's Elizabeth Neo spoke to Ari Sarkar of MasterCard. He said assessing the creditworthiness of an individual remains essential to the industry.
BNPL is another creative name for essentially access to credit. What BNPL in any way does not take away the science of good, solid risk management and credit underwriting. I think that remains foundational to the credit card industry, that remains foundational to BNPL. I think you've seen the euphoria with BNPL, and the fizz has started to come out because some of those fundamental principles have probably been either not adhered to or one's been too aggressive in the assumptions. So I think BNPL at some level gets a bad name through the cycle that one has seen. But like with any new product category, it's a solid marketing play of access to credit being packaged as a buy now, pay later product. But that's what credit from banks have always done. I think technology is enabling where your ability to pay for things in installments enabled at the point of decision making is a very big fundamental change, and that drives consumer usage. But the underlying assumptions of good risk management and credit underwriting still doesn't go away if you want the product to be successful.